It is clear that today China and the United States have the world's biggest economies. However, in the 1980s, Japan was viewed as the economic miracle and America's biggest economic threat. What followed was more like a financial disaster, which led to the term Japanification, which relates to the mix of stagflation and deflation. The question is whether China will follow Japan in a period of sustained economic decline. Now, how weak is China's economy? There is a huge range of data that suggests that it's slowing significantly. This is especially seen in its real estate sector and the current crisis with China's Evergrande Group. Now, questions are being asked whether China's economic slowdown is reminiscent of Japan's economic fall. In recent months, we have seen China's economy stall, from COVID restrictions and a big real estate crisis, which makes up 30% of Chinese GDP. We saw China's GDP slow significantly this last quarter to 4.9%. Power shortages have struck China, which have forced factories to close down, as a surge in the price of coal and a shortage of electricity forced authorities to cut off power. 13 major banks gave estimates of China's future GDP growth. 10 banks cut their forecasts. Major negative factors have hammered the Chinese economy, from slower than expected consumer spending, real estate crisis, natural disasters, and regular crackdowns on the COVID crisis have severely hampered China's economic growth. China and the US are two economic superpowers of the world. An economic slowdown in either of these will have global consequences. Japan experienced a form of an economic miracle post-World War II. The nation-state, by 1956, had a GDP which had overtaken pre-war 1940 levels. During the post-war recovery, the state's GDP rose at an average of 7.1%. Now, fast forward to the late 1980s, Japan entered an age referred to as the Age of the Bubble. Stock and land prices showed remarkable increases, and the economy enjoyed an investment and consumption boom. Overseas investment from Japan increased rapidly, and Japan became the world's largest creditor country. Although, when Japan hit the 1990s, it began a 10-year period known as Japan's lost decade. The state experienced economic stagflation and price deflation. While the nation's economy outgrew this period, it did so at a much slower pace than other modern states. Japan suffered from both a credit crunch and a liquidity trap. Where Japan's downfall began was with its equity and real estate bubble bursting in 1989. Equity values fell 60% from late 1989 to 1992. Even today, Japanese stocks have yet to reach their record highs of 1989. Also, land values fell 70% from the 1990s to 2001. China's current problems look very similar to Japan, and some may argue worse. A major factor to the Japanese decline was the effects of an aging population on growth. Japan's working age population fell in the mid-1990s, and its overall population began to shrink in 2008. China's working age population already peaked 10 years ago and currently is experiencing a contraction in its population. Japan's drag began after the economic bubble. China's has already been contracting for years. This chart shows that China's population has been growing at a much slower rate compared to the rest of the world. As seen with Japan, an aging population has a negative correlation to economic growth. Another area of concern for the Chinese economy is that of the Chinese corporate spending. Andrew Hunt of Andrew Hunt Economics in London estimates that corporate deficit has been running at roughly 14% of GDP in recent years. In Japan, it peaked at about 8 percentage points of GDP. Chinese bank lending growth has been even more rapid than that of Japan. This is a point at which debt dynamics can get ugly. In China, the property sector is important to economic growth. 30% of China's GDP comes from real estate. Local governments have relied on selling land to cover spending. Huge amounts of lending has gone into construction. In 1989, construction spending in Japan amounted to just under 8% of GDP. In China, it's 15% right now. Now in Japan, the real estate bubble got so big in the 1980s that property prices still haven't recovered to this day. China's Evergrande Group is poised to default on 300 billion of debt. That's the most debt of any company in the world, worth around 2% of China's GDP. Another major concern for China's economy is the banking system, which is likely to be more crippled in the coming years. Many Chinese banks already struggle with funding themselves. It's estimated that Chinese companies have some 5 trillion of foreign currency denominated liabilities. This equates to roughly 10% of the Chinese financial system's liabilities. We are seeing panic in many areas of the Chinese economy. Bonds in the property sector have crashed, making it more and more difficult for some of China's biggest companies to borrow. The IMF is expecting China's GDP to expand by 5% a year by 2025. However, this is far below its original expectations of 10% a year it previously made. The Atlantic Council thinks that it could be as low as 3% by the middle of this decade. There's no doubt that their economy is slowing and looks like a potential 1990s Japan-style slowdown. Despite a potential Japan-style slowdown, there is no doubt of China's economic rise. In the last 20 years, China has accounted for almost 1/3 of gains in global net worth. Global wealth tripled over the last 2 decades, with China overtaking the US for top spot globally. Now, why is China's slowdown not like Japan's? Although similarities exist, when you look at nuances, differences appear. When looking at real estate, Japan saw that real estate price growth in the 1980s was far in excess of the growth in GDP. China has had the opposite during the last 10 years. Japan's real estate prices relative to GDP more than doubled from 1980 to 1990, while in China, that ratio has dropped more than 40% in the last 10 years. This suggests that rising demand for real estate in China has been supported by increased productivity in other areas of the economy. Another difference is that when its real estate bubble burst in Japan, its per capita incomes were comparable to the US. In China, GDP per capita is less than 1/5 of the US levels. This suggests more room for household income growth to support housing demand. Yang Wang, a chief strategist at Alpine Macro, said that so long as Chinese economic growth and household levels continue to improve, demand for better and bigger housing will appear. However, China's future economic growth can be very well hampered by President Xi's desire to pursue control via his common prosperity doctrine. The doctrine states that China's future will be led by Marxist values and its unshakable commitments to developing governmental controlled companies while supporting and guiding the private sector. It also stated its desire to build up the country's technological self-reliance as a strategic economic goal. The common prosperity doctrine is hardly surprising for a nation state like China, and this doctrine could very well have long-term ramifications on China if Xi continues as president until death. China's economy is large, and if China's economy were to slow down more than expected, it certainly could have grave consequences for many countries that are linked to China through trade. Given the size of the Chinese economy and its extensive links with the rest of the world, financial stresses could significantly strain global financial markets for a deterioration of risk sentiment, pose risk to global economic growth, and affect the United States. It is clear that China is facing a period of potential economic decline. This is clearly seen with its current real estate crisis led by Evergrande. Similarities appear when comparing the downfall of Japan's economy, however also slight differences remain, which will impact China's economic direction.